Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning. This is Quincy Krosby. It's The Talking Point. It's Tuesday morning, June 20th. Right now, as I look at the futures market, it looks as if it is going to give us a difficult opening. But keep in mind, the market is overbought. When we reach overbought territory, the market can keep going. We know that from history. But normally the market likes to digest the gains, wait for a next catalyst to see if, it could push the market higher. But it's very similar, for example, to oversold. When the market, keeps selling off, at some point a catalyst comes, just turns the market around. But again, I just want to repeat, markets can continue to sell off. They can continue to climb higher, even in overbought territory. However, the norm is that the market will take a deep breath and, again, digest the gains, see some selling off, and wait for a catalyst. Last week, the market was very much focused on broadening out. And I can't stress this enough because the criticism of the market had been, well, it's only a handful of stocks pushing the market higher. What we saw, again, was to see more names coming in, more names climbing higher, making new highs, for example. But also, we saw the Russell 2000 joining the rally. And that's important because they have been mired in concerns over the bank sector. Remember, the Russell 2000 is home for small banks and also for regional banks. The fact that investors saw attractive valuations, needless to say, because of all of the selling in the Russell 2000. That's not enough, to go into, an index or those names and just say, well, it's cheap. Well, we call that a value trap. They need to see more. They need to see why should we be going in here if there are so many lingering concerns about the banks. But nonetheless, they obviously made a determination that the Russell 2000 is viable, and I'm going to use that term. I'm not suggesting anyone goes into the Russell 2000. What I want to say is what it indicates. And it also, the index itself is a bellwether for economic conditions, because the Russell 2000, the small and mid-cap names in general, are much more risky than the S&P 500, technically riskier. They are more volatile, and they are much more attuned to economic conditions. And so we keep our eye on them, and having them join this rally is extremely important because it indicates that investors are looking at it and saying, well, okay, we heard the Fed, they skipped a meeting, they may give us another rate hike, but we don't see necessarily a recession around the corner, an impending recession. Also, the notion is that if there were a recession, and I have to stress this, if the Russell 2000 can maintain, investor interest, it would suggest that the expectations are that it would be a mild recession. The reason I need to stress this is small and mid-cap tend to be volatile, and on the risk scale, they are riskier than the S&P 500. So we'll keep an eye on, the market recovering this week, if there's a catalyst for that, and whether or not the Russell 2000 joins that. Above all else, we just want to see a market that has more participation. That's my point in this call. And that was positive, and you probably heard that in the media. It's positive to have the Russell 2000, the small and mid-cap, join the large-cap names, not to mention the mega-cap names, in this rally. It's getting broader, and that is what you want to see. Now, this week is an important week for the market because this week, if you thought you were finished with the Fed, no, you are not. Jerome Powell is up on Capitol Hill this week. It is the biannual testimony between the House and the Senate. Now, the speech he gives before the Q&A is always the same. It's a written speech. The market will hear or see what it is usually before he starts. I want you to pay attention if you're following all the stuff about the Fed. Will we get a rate hike? Is the answers he gives, particularly at the House of Representatives, because remember those representatives really are very much focused on their Main Street constituents, right? That's whom they serve. And they don't want to see more rate hikes. Absolutely do not. And so let's see how he answers them. And obviously for the overall market wants to glean any sign of how he feels about rate hikes and how he feels about inflation. And does he think that over the next number of weeks, remember, the Fed doesn't meet again until July 25th and 26th. So the question is, does he see the possibility that the rate hikes, the cumulative effect of all of the rate hikes, really do start to bring inflation down at the core level more quickly? And at the same time, someone may ask him, because remember, the questions are written by the staffers, what about housing? What about the leases? We know from all of the industry reports that overall leases are less expensive for most of the United States. At some point, that is going to come into the consumer price index. And someone should ask him, are you aware of that? And he's got to answer, of course, yes, because if we all know it, they follow all of these. And it's the core that is what is stubbornly high. But that should also see some relief as we start to get those reports coming into the consumer price index and also the Fed's preferred index, which is the producer price index, which is the one that follows the CPI that comes out usually the next day. And that is also showing that the prices paid is actually coming down for all of the goods that go into the manufacturing process. So there's quite a bit of data coming in before the next meeting, but certainly the market wants to get a sense of how he sees the inflation picture. And I do want to repeat, at the House of Representatives, they ask really interesting questions because they are representing the small and mid-cap banks in their states, in the areas where they live. They are representing the people. I always say that the Senate is, much broader, higher level, but the market will focus on specifically the Q&A from both the Senate and the House. Also, this market right now, again, is short-term overbought. We're waiting for a catalyst, but let me say it's leaning bullish. The sentiment is leaning bullish. We saw selling of, or folks coming out of money market funds. That money obviously went into the market only because we saw the volume in the market climb higher. That means more money coming in. Portfolio managers also coming in. In many ways, even if they are slightly bearish, they are almost forced to go in because of that fear of missing out and having a market just run away from them. And the question now is, what is the next catalyst for this market to climb higher? One may be, I just want to point this out, if Powell's testimony and the answers, the questions and answers are, well, I don't see another rate hike. If he actually comes out and says that, which I doubt, but if he leans toward that or the market interprets it that way, that could be a catalyst. And also, remember, the earnings season starts officially on the 14th of July with the big banks. But we're going to hear from companies before that. And we want to hear what they have to say. What do they see? And, what is their guidance? And we'll see revisions coming into that official opening of the earnings season. And we want to look at how many upward revisions, how many downward revisions going into the earnings season. So that's going to be important as well. Very important, of course. This week also, we're going to have existing home sales. last week, at the end of the week, we had optimism coming out of the home builders survey. They turned the corner, and that is good news. And why would they be more optimistic? Well, because their view is that the Fed, even if they raise rates again one more time, they're almost finished. That's why. And that mortgage rates will start coming down. So that was good to see. This week, again, we will have housing starts, and, we're very much focused on what these data releases suggest, but also we heard from a number of home builders, and they are much more optimistic at this point. So then we'll also be looking at very much looking at the leading economic indicators. That's important. These will be just focused on the United States. And what we want to see, and that'll be Thursday, by the way, what we want to see is it turning the corner, turning up. One thing about for the markets is not that it goes shooting up and that, that's when you wait. You want to see a consistent turn up coming off of a bottom. And that's going to be important because leading economic indicators really do set the tone of where the confidence starts to turn. Remember, we've said this over and over again. The market is not the same as the economy, and the economy is not the same as the market. The market tends to look ahead by many months, actually. But when you take a look at the leading economic indicators, whether or not it's for global or it is just for the United States, it tells an important story about the direction, the trend, and that is what we will be looking for when that comes out also on Thursday. In terms of global markets, I want to also mention China. The Secretary of State was there speaking to his counterpart, and apparently the President, Xi, came in and talked to him as well. The goal is for both sides to just sort of temper the rhetoric, temper from both sides. However, one of the most important issues really is, how the Chinese leadership in Beijing see Taiwan. And that is one that basically doesn't change. The leadership, in fact, just before Blinken was there, that's the Secretary of State, there was a commentary that, Taiwan belongs to mainland China. So that's a sticking point. It's very hard to see how that changes, and that both sides agree on what should happen. But nonetheless, the market is more focused at this point on whether or not China introduces fiscal stimulus that pushes up demand for trade, right? Because right now the trade is down, exports are down, and the ramifications are global, so that the market is hoping to hear something more. We were expecting to hear something on Friday when their state council met. That's really their cabinet, and really it was very vague. There have been a number of rate cuts. We saw that, but not enough to grab the excitement in global markets. So this is quite important. They're the world's second largest economy, and what they do in terms of boosting their domestic economy is extremely important for their trading partners around the world. We'll see if this week we get any more information. The market really is waiting and, again, hoping that they introduce more, again, not just monetary, which is their central bank, but fiscal stimulus that helps boost the overall economy. And then the ramifications are for trade to pick up as their economy expands, and it truly does help the global economy. You will see, for example, oil prices picking up on the back of any news that China is that the economy is turning the corner and growing, and obviously with a fiscal stimulus package that would help underpin growth in China. But so far we haven't seen it. I should end this call by saying we are seeing West Texas Intermediate crude and also Brent higher this morning. We may recall that the Saudis made a decision that they were going to cut oil production. That's in addition to the oil production by the overall OPEC. But we also know that the driving season is picking up in the United States, and that the government in the United States, the Energy Department, is trying to replenish some of that oil, 3 million barrels, that was taken out of the Strategic Petroleum Reserve. That process is ongoing, but that would also help push up the price of oil a bit, because it would suggest that oil is coming out of a corporate stockpile, because that's how the oil goes back. And that would also suggest that perhaps we will continue to see the replenishment of oil over the course of the next number of months. Remember, the Strategic Petroleum Reserve is there in case of an emergency, and much oil has been already taken out when the war with Russia and Ukraine began, and there was tremendous pressure on oil prices. In any event, this is going to be a busy week for the market, a reduced week, but nonetheless a very busy week in a market, to repeat, that is overbought, and a market that now sits, tries to digest the gains, and then wait for a catalyst to either continue the advance or to basically, remain, at this level. It's important, but we will start hearing from companies, and that is going to be important. The opening of the earnings season, to repeat, the official opening is July 14th with the big banks, but before that, we will start hearing from corporate America with either revisions higher, revisions lower. And sometimes, there'll be a discussion from the CFOs and the CEOs of these companies before their actual earnings reports. So take care. Have a very good week. We'll be back next Monday. Thank you. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.